SoFi's 10Q is finally out, being delayed about a little bit over a week since the actual earnings call came out, and this shows us some amazing numbers whenever it comes to SoFi's financials. The 10Q is so important if you want to dive really deep into a company's business. Instead of just looking at a press release or an investor presentation where it just gives you the numbers that they want you to see, this one sort of shows us everything behind the curtains. We actually get to see how the sausage is made. But what I've done for you guys in this video is actually break it all down into one Excel workbook where we actually brought it down into 3 different sheets, looking at their different products, their actual financials that we saw on the 10Q, and then their cost of loans, which is super important because it's our biggest segment. Jumping right into it, for people that have already seen the channel, it looks a little bit different already, okay? I've reduced the amount of data going from all the way back from Q2 of 2020, which a lot of people said that the numbers were just way too hard to read. So what I'm going to be doing is showing off the quarter over quarter and year over year growths. That way it's the information that people are really paying attention to. So these numbers, finally, hopefully you guys can see everything, and it's the numbers that we want to see, and it's still enough data to actually spot some trends. Now, the numbers that we're looking at in these products, I mean, I've already covered a first impressions of, but the numbers that we want to see are in this Q3 of 2022, and the numbers were honestly fantastic for the most part. There were a couple outliers like in their credit cards and their preferred loans that I thought could have been a little bit better, but it doesn't really matter considering those are tiny, tiny prospects compared to our lending segment, which saw the largest growth that it's ever seen, and it's our most profitable. But you guys didn't come here to see that. You came to see the financials, and that's what we have here under this column right here. This is the new Q3 that I've been able to update. Now, jumping right in, obviously we can look at revenues and net differences and everything like this, but customer acquisition cost is a new tab that I've also added to this chart. Now, if this is your first time ever looking at SoFi's customer acquisition costs, there's going to be some sticker shock because it's quite high. Unlike some people that might look at, a Square or something like this, where the customer acquisition costs are in their single digits, this one is not quite like that. Obviously, to get a direct deposit user, we give them about $300 just for doing direct deposit on top of a $25, sign-up fee for actually getting into SoFi checking and savings. So the numbers can already be that quite high if people are just using direct deposits, let alone if we actually cross-sell them into, credit cards or personal loans or anything like this, where maybe we even charged a little bit extra on top of that to get them into multiple products. But don't worry, we're expected to make a lot more than this on a per customer basis whenever it comes to a lifetime value of a customer, but it still is expensive to start signing up 400,000 new members in a single quarter. That's obviously leading to a big fee in our expenses. And another part that we just don't like to see is the fact that these customer acquisition costs have just been kind of steadily rising. And Q3 is looking kind of exceptionally hard to look at considering the fact that even whenever I plotted it out all the way back to Q2 of 2020, we have not seen any customer acquisition costs this high. But it hasn't been all that bad for SoFi. That was just one single metric that we're looking at. Whenever we look at revenue quarter over quarter, I mean, you're looking at from Q2 to Q3, we grew 17% in a single 3-month period. That's like unbelievable, especially whenever you look at our competitors like Upstart or Robinhood or Affirm or any of these, right? They're all doing terribly right now because of the macro environment, and yet SoFi is clutching it out and doing amazing things, and on both sides, on the bottom and the top end, right? On the bottom end, we're seeing from Q1, amazing growth in EBITDA, Q2, even better. And then in Q3, also being able to still hold that up on 120% growth in EBITDA on top of our previous growth. So that's truly, truly exceptional. And it is because of our bank charter, and people just didn't give us credit for it. Since we've had the bank charter, the stock has only gone down, but yet our actual profitability has been skyrocketing. And that could explain the higher customer acquisition costs right now, because we're willing to pay for a better client, because obviously it's extremely profitable at the end of the day right now, at least for us, compared to the competitors. But moving on from that, let's look at student loans overall, as the FICO scores in the past couple quarters have slowly been going down. Now, that's to be expected, and honestly, it's still at 771, so I don't think we have really anything to worry about. Remember, that's an average, okay? So that's super, super exciting. For every person that we have at 750, we also have at 790, so it's super awesome to know that. And then even with that super high credit scores, our interest rate is also climbing and at a pretty good pace right now. So this is also showing that our average income recognized is actually still very, very high. But what we're seeing like crazy is the actual amount of sale of loans was so small, and it's been going down steadily. And now that this could be because of the bank charter and that we're actually holding on to the loans longer, which is also making for us to actually earn more income, like income recognized from this, because we're not selling the loans. We can hold them longer, so that's expected to go up. For now, I'm going to skip the average loan balance and potential interest right now because we're going to go on to it on the other sheet as well. Let's just look at home loans first, where we can actually see the FICO scores. It's very hard to actually point out if we are seeing a trend, considering that it dropped dramatically from Q1 to Q2, but then in Q2 to Q3, it's starting to rise again. That may be because 744 is just a little too low for us. That being said, the interest rates actually earned on home loans is skyrocketing right now. And that's obviously just because of the macro environment. And it's just a matter of whether people are willing to pay that. And obviously the interest earned with that interest rate climb is just going up dramatically. So that's really, really cool. Just look, quarter over quarter, we're earning almost 50% more, or rather 40% more of what we were just seeing a quarter ago on income recognized. It's still a small number whenever you compare it to the other quarters of, student loans or personal loans, for example, but still, it is still, real growth, and I'm happy to accept it. But sale of loans, once again, dropped, continuously quarter over quarter. And that's also probably because of our bank charter and just a lack of new customers on the home loans. Whenever we look at the products over here, we can see home loans, the growth just really isn't there anymore. It's sort of a dying product. So, whether people honestly want this product from SoFi or not, they are willing to pay the higher interest rates, and I'm happy for that, considering how much of a dramatic change that is, but also, the real estate market's slowing, everything like this. But we'll have to see how this product performs whenever we actually get it out into a normal real estate environment, whenever, interest rates are starting to drop again. Average loan balance and potential interest, we're going to see on the next page, so let's just move past that for now. We're going to look at personal loans, where on the average FICO scores, we could see that the trend is sort of all over the place, but in the overall scheme of things, it is going down just like our other lending products. But our interest rate earned, this is so crazy, guys. We are earning 12.2% on our average personal loan. Okay, so there's people paying a little bit less than that. There's people paying a little bit more than that. And it's just an absolute amount of interest rate earned that we're getting there. It's just absolutely crazy to see. And what we're doing, because obviously our bank charter, the higher interest rates and everything along these lines, the interest income recognized that we actually took home was so high, over 40% higher than our previous quarter. Like, this is 3 months, 3-month difference, and a 40% increase on our income recognized. So just absolutely insane. It's a mix of the higher interest rate earned, higher rate of us actually holding the actual loans on our balance sheet, and everything in between. And you can tell that we're holding a lot more, because look at the difference in quarter over quarter sales on our loans. 1.1 million down to 750,000. So we're really keeping a lot of it on the books, and considering that our originations for these loans still continue to climb quarter over quarter. So very, very exciting. And then on to our financial services, where things get quite different from our loans, right? Obviously, let me catch you up to speed. Referrals is like our third-party offerings that we get lead generation from offering people different softwares and programs. And then this obviously gets us a nice lead generation that's been consistently going up quarter over quarter. Now, on our brokerage side of the business, what we're actually doing is payment for order flow. So the more people that actually buy and sell stocks from us, the more money we actually make on our brokerage side. Now, in Q3 and especially in Q4, the stock market was at all-time highs, and so people were trading back and forth, right? Retail traders like you and me, we just don't love buying in the red. I mean, I do personally, but most people love buying whenever stocks are green and they sell when stocks are red, and it's a terrible habit, but that's just the truth. So as the quarters go on, people get worse and worse feelings about the stock market overall. They lose hope and they stop trading as much as they did before. Also just, running out of money as well, right? But this is why we're seeing less and less money here. It has nothing to do with SoFi. It's just people are not buying as much in the stock market, and it shows because obviously we're in the most depressed market that we've seen in many, many years. Our payment networks is where we make all our money off of interchange fees from our debit cards and our credit cards. People tapping onto different merchant devices allows us to take, a small fee from that, and that's allowed us to actually return back to where we were in Q1 with a lot of revenue coming from different transactions in our payment network. So that's very, very exciting. On our enterprise services, this is quite interesting, right? This is more like SoFi at Work, offering different businesses actual retirement plans and different employee benefits for them. And this is allowing us to make some money here. I mean, it's not a lot, but it consistently goes up quarter over quarter. So it's a good way, just to make a little bit of extra money. It's not costing us much. And hopefully in the next year or two or even longer, it's going to just continue to climb and be a great source of revenue for us. Now, last and maybe least this time, okay, the technology platform side of things saw a rough quarter this time, okay? The technology platform services as we go along just was doing better and better, and then just a teensy-weens better, in Q3 of 2022. And the same thing can be said for our payment networks, right? Like, we saw great growth in Q2 and then right back down to where we were, or even lower than in Q1. So, our payment network really didn't see the side of things on technology platform. Our actual software licenses, this is very specifically Technisys, just didn't see really anything good. And so this sort of led us to have a little bit even worse of a quarter, very stagnant quarter over quarter from Q2 to Q3. Out of the grand scheme of things, one single quarter is not a real sign of how things are growing over time. we'll have to see many quarters if it stays stagnant to really start to be worried about the technology platform. But let's actually talk about the cost of loans for now. Guys, listen when I tell you, this is the most exciting sheet for me to talk to you guys about. This shows so many really interesting things. One is our warehouse facilities. This is like corporate debt that we can take on to actually fund our loans. What we're seeing is that it's been decreasing quarter over quarter from Q1 all the way down to Q3 since we've had that bank charter. And that's allowed us to actually, take on less debt because it's, really high interest rates, 2.9%, right? Versus our own deposits. So instead, we're still growing. So we still need money to fund our loans, but we're taking it from a different source. We're taking it from our own customers' pockets. It sounds bad, but it's actually really safe. Now that we're a chartered bank since Q1, we've been able to take different amounts of money, okay, from $442 million to $1.8 billion to $3.8 billion of interest-bearing deposits, okay, which means this actually costs us money to fund our loans, and it's at right now in the most recent quarter to 1.49%. Now, I know what a bunch of people are going to be saying. Tanner, SoFi is offering loans for 2.5% to 3%. How could it possibly be 1.49%? Remember that this was months ago, from like July, August, and September, where their interest rates were also lower. And there's also a difference between direct deposit users getting 2.5% and a bunch of people just putting money with SoFi that don't have a direct deposit where the interest rates are much lower. So it actually averages out to 1.49%. So the cost of both of these together, the warehouse facilities and their interest rates and the deposits and their interest rates, leads us to a total expense that is still climbing, obviously, just because the deposits are just skyrocketing in the amount that we're actually going up versus the slow declines that we're seeing in the amount that our warehouse facilities are going down. Now, that might seem like it's bad, but the amount of new funded loans that we're able to get is much higher. So we actually do still want these deposits to go right through the roof, right? We have a bunch of flexibility if we have higher deposits. Now, let's look at student loans, home loans, and personal loans all at the exact same time. Maybe that's a good angle to look at it, okay? First off, average loan balance. Like I said, I would return to this. For student loans, it's just sort of steadily been going down. This is because people are just slowly paying off their balances with student loans, and the moratorium just hasn't ended yet. So by the time we actually get to January 1st of 2023, we should be seeing a large amount of new originations in student loans. But for now, we're just slowly getting paid out, and that's sort of why our interest rates are climbing, because that's the tiny bit of new customers that are coming, but they still are not enough to actually make the total loan balance go up. But that leads us to an interesting one, annual default rate, where this is where people just sort of, leave the keys on the kitchen table and walk out of their loans. Obviously, we report that to the credit bureaus and they might have to declare bankruptcy or something along these lines. But for the longest time, it's been at 0.4%. Just this last quarter, it actually stepped up to 0.5, and that could be the jump in interest rate. But yet, we still didn't see that interest rate back when it was 4.6%. So, it is a little bit hard to stomach, but it really is nominal at the end of the day. But still, I don't want to see it go up. Home loan average loan balance, for the most part, really hasn't moved much. We are talking about the difference of $1,000 to $2,000 up or down. And this is just because the amount of clients that we've been seeing for our actual home loans has been, almost nominal. 560 some odd new signups, right? What is it? Exactly, 579. Whoop-de-doo, right? So the number's not really going to change. People are still paying it down, and across the board, our default rate stays the same. Now, before I talk about the total weighted average, which I'll get into what that actually means, I just lastly want to talk about the actual total loan balance of student or personal loans, where we actually get to see a very healthy climbing total loan balance. Whether you want to call it healthy or not, we're going to be making more interest. It's just whether the default rate is going to outweigh that, right? So the default rate steadily has been climbing quarter over quarter practically. And this, from Q1 to Q2, I thought was a little bit worrisome. A 0.2% increase, which was a lot. Now it's a 0.4% increase on top of that. But obviously with that, we're also seeing a 0.6% increase on the, the interest rate side of things. So it still is balancing itself out. And actually, we're still making more on our loans than we were before, even with these defaults. But still, no one likes to see that that's happening. I would like for it all to be stayed with us. But that's sort of the nature of the business, right? 5% default rate, it's high, but our interest rates are higher. Now, total weighted average is a metric that I just wanted to show off how important each one of these loan segments is to our overall lending platform. Not the entire business, just our lending side of the business, okay? Where student loans overall, quarter over quarter continues to see large decreases in how reliant on student loans we are. It'll be cool once Q1 comes out and we actually get to see those numbers, how different that actually is going to change whenever, the student loan moratorium ends, how quickly that spike is going to happen. But really also, very interestingly enough, home loans is starting to see a big spike just because the amount of interest rate difference, that the amount of money that we're making from the home loans is spiking. And so is the actual weighted average. And that's quite cool as well. Personal loans also just quarter over quarter has been climbing steadily. And it's obvious because our interest rates are climbing, the amount of people that are signing up, and the loan balances are all climbing. It's the best product we have across the board. There's nothing I like more than SoFi personal loans. Now I want to show you guys potential interest. This is a metric that I've created that takes out the idea of selling our loans and just looks at the number of how much it would actually make if we kept all the loans on our balance sheet and how much it might cost us if we took out all the expenses. Now the reason this is important is not as much the number, because we're not actually making this number, but it's the actual trend of how it's actually going. If it's starting to go up, this means that we could actually show that to other potential buyers of our loans, and that means that the cost of our loans to purchase would even go up as well. It's a really good way just to show off the health of these loans, so whether we're holding them on our balance sheet or selling them, it's still going to be important to know what the potential interest is. So what we can see first off is that student loan potential interest has been dropped off dramatically because the interest rate drops, but also it's starting to climb back up because we're slowly starting to see that recovery, and the default rates has sort of been, almost nominal to the point where it's really not affecting the formula. Now, whenever we look at home loans, completely different story. Climbing, 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 climbing. It's just absolutely amazing, right? Because the default rate is absolutely nominal, and the interest rates are still climbing. And whether we see not a lot of new products, the actual amount that we could sell this whole portfolio for continues to climb overall. Now, personal loans, did you expect anything else? Straight up in the air, right? Absolutely amazing, just because our loans are doing amazing in every regard. And the actual annual default rates and the climbing of the cost of the loans just isn't enough to offset how much we're growing. Now, what I find is really, really interesting is the total net potential interest. Now, potential interest is just everything, without actually costing it all in. The potential net interest is where I actually bring in all the expenses all together. And this is where we get to see sort of a flat out total. In the past quarter, from Q2 up to Q3, we saw a massive, massive increase. So exciting. Could really increase the total cost of these loans to actually sell. We're really offering a premium product whenever it comes to our loans. High interest rates, low default rates, and low cost of funding. So this is very, very exciting. Whether these numbers are actually meaningful in the overall grand scheme of SoFi, the trend really is, okay? The actual trend of how much we're going to be able to sell our loans is impacted by funding, is impacted by default rates, and is impacted by the interest rates that we're actually charging. So all of that is super important. And right now in Q3, we're seeing some great numbers. In the near future, I'm going to be editing this to actually show off more metrics to see how in depth we can actually look at SoFi's business, whether it's good or bad. And just to support my efforts, guys, all I really ask of you is to hit the like button and subscribe down below if you want to see more financial content just like this.